Well, good morning, everyone. Pleasure to be here in Lethbridge once again, and certainly do appreciate the time that you've all taken to come out and visit and participate in the Farming Smarter Conference. I'm sure there's going to be lots of great information and things to learn while you're here. Before coming out from Winnipeg to come out and do this talk, I was having a discussion with my wife regarding the kinds of things maybe I would be talking about during the course of this presentation. She says, don't try to be charming or too witty or intellectual, just be yourself. So I'm going to do the best I can here to talk about some of the issues that are affecting our grain markets that I think we're all interested in. I want to talk about some of the fundamental features that are underlying these grain markets, but I have to admit that in the past 2 years especially, they stand apart from most in the 30 years that I've been participating in following the grain markets. Things like weather, of course, are significant market drivers. Supply-demand issues of various types are helping influence our prices. But it's the influence of politics or political interference into our commercial grain marketing activities have had more of an influence on the grain markets, I think, than at any other time in the process of my career. And for countries like ourselves here in Canada and agriculture, which is so dependent on exports, this certainly provides some new challenges that are influencing our markets. Tariffs, whether they be tariff or non-tariff type barriers, have popped up everywhere, affecting almost every commodity, it seems, these days, but coming from different regions of the world. We're well versed with the issues of our relationship with China and how it's influenced our canola supply-demand relationship with them, and our trading environment. India certainly has been an influence, the 800-pound gorilla of the pulse markets, both tariff and non-tariff barriers that have affected our pulse trade. Moving our durum to countries such as Italy that have instituted country of origin issues, and also some issues that we've had with Algeria, major customers of ours on the durum side. Saudi Arabia, they're the largest importer of barley in the world, and a significant wheat buyer as well, but certainly the Saudi government these days aren't too happy with our own Canadian government and making claims and such on behalf of human rights, and the Saudis certainly aren't happy about that. Brexit, England is going into their next federal election in the next couple days, and the geopolitical shifts in Europe are affecting what has been a recent free trade agreement that we've done with Europe. And of course, we have the disruptive policies of the Trump administration down in the United States. And they have certainly gone a significant distance in terms of rupturing global supply chains. Fractures are appearing in the rule-based system of global trade. And the Trump trade policy, to me, these days is akin to basically going fishing with dynamite, blowing it up and seeing what pieces we can pick up in the end. So things like World Trade Organization Dispute Panel, as of yesterday, there's dispute settlement panel no longer functions at the WTO because the U.S. refuses to allow new judges to replace the outgoing ones. So we have all these issues that are all affecting the marketplace. Are they permanent issues, especially as in relation to the America First policy in the United States, which has been grafted into nationalist programs in other countries as well, India in particular? Is this a permanent feature that we're going to have to contend with? That's still a debatable point. I think things will change in time, but we'll get back to a more globalized view of the world as opposed to every man for themselves. But I do think we do have some bumpy roads immediately ahead of us. So, in talking about different grain markets, I think what I wanted to start off, and I got a long-term graphic here, and anyone who's seen my presentations in the past knows I've seen this before. This goes back to about 1990 or so, and I use soybeans in this particular case to get us going, but I could use corn, I could use canola, I could use wheat. It's a similar pattern that I see, and the point that I just want to make on this one right now is within the boxes you see sideways ranges that have developed over time. So basically commodities trade up, down, sideways. Up, down, sideways. That tends to be the pattern of the commodities. Rally because of shortness of production somewhere in the world, or maybe new demand elements come up to light. Farmers respond worldwide with increased production, drive prices back down. Then we go through a period of sideways, which is essentially the supply-demand variables of the marketplace just sort of sorting themselves out and finding a new equilibrium. And we go through this process basically over and over again. And you can see in the last pattern there, where I have the blue bars, we went through about a 2-3 year period of basically going through, after an significant up and down period, going through that sideways range. And in my mind, I was thinking we're waiting for the next bullish catalyst along to help drive grain prices to a new level higher again. But something happened. June, July of 2018 happened. And that's when Trump initiated, well, he started trade wars, threatened trade wars with everyone, but that was the initiation of the trade war the United States now has with China and still is in place. So the markets in commodities in general have fallen off and have now gone into their new sense of equilibrium, as we're into a new paradigm right now in terms of trading relationships, as global supply chains have been blown up. So now there's conflict. New buyers, new sellers are all battling for new positions, who's selling to who and when. And this element of uncertainty that has entered the marketplace, markets don't like that. Uncertainty breeds fear. Fear breeds selling, and that's been one of the things that have been significant in keeping pressure on many of our agricultural markets. So this is a process, I think, that we are learning how to contend with. But you know, the relationship between the Chinese and the Americans, certainly the Chinese are buying a whole lot less soybeans this year than the past year because of this trade war that's in place right now. But it's not the only issue involved. You know, you probably hear about African swine fever in the media. It seems like a faraway disease and not something we necessarily have to pay a great deal of attention to, but it is significant. You know, you may not be able to make out all the details in there, but about maybe five of them down. Canada's pig crop is about 14 million head. United States, the third at about 75 million. European Union, 165 million pigs. China on top, 440 million pigs. Over half the world's pig population resides in China in 2018 until swine fever came in. And in 1 year, got knocked down 40%. So there's certainly less need for whether cereal for energy, for soy meal and protein and greens, for the protein in a diet for a significant pig population that has declined by over 200 million head. Certainly that means there's less need for soybeans and soybean meal. And that certainly is an issue. And this is not an issue that is isolated only to China. African swine fever has now spread throughout Southeast Asia and up into the Koreas. There is evidence of it showing up in Eastern Europe and such. So there is certainly a significant concern. So this story is not over yet. But pork is a staple meat of the Chinese diet. So aggressive plans are underway to repopulate the pig population in China. But of course, that's going to take a matter of years to accommodate. So there is, this issue that is underlying. But while less meal is needed these days, the need for vegetable oil continues to rise unabated. Whether it's for human consumption or for industrial purposes, the need for veg oils is still strong and growing. And that's important for us as canola growers, because canola is a very high oil content oil seed. So that underlying demand feature is there. So with that, let's take a quick look at canola. Ending stocks this year, StatCan came out yesterday with a production number 18.6 million tons, about 700,000 tons less than their previous forecast. The trade's not sure, nobody's quite sure. With the amount of canola that's still residing out in the fields and will likely overwinter this year, is it 1 million, 2 million tons? How much of that is recoverable? All of this stuff is a big question mark on the market right now. But from the trader's point of view, from the commercial's point of view, there still is sufficient canola supply here in Canada that no one's worried about us running out of canola at this point in time, despite maybe some tighter canola scenarios that are developing worldwide. So the ending stocks projection right now is anywhere from 3.5 to 4.5 million tons. If this new production number is correct, and I suspect it may be a little on the light side, But I suspect that we're still looking at a scenario of ending stocks this year that is somewhere in the territory of being record large. Where that canola goes is important. And in the red bars you see there is what China's relationship with us have been, how much canola they've taken in the past. In the second to last column, we didn't see the real evidence of Chinese cutting off purchases of Canadian canola so much because that happened. First, the news of it is started around January or so of problems starting to develop. But it wasn't until March where two of our significant grain companies were essentially cut off of the Chinese marketplace. But we are seeing the effects of slower buying interest take place this year now in the final column. And that is something we're going to contend with. In the green portion of that final column, that's I've lumped together Pakistan, United Arab Emirates, European Union. Certainly the European Union has become a more significant buyer of Canadian canola for their biodiesel sector. So that's been a positive. United Arab Emirates has also been an increased buyer of canola, not so much because they need more canola themselves, but they operate a toll crush, which is essentially buy our canola, crush it, send the oil and meal elsewhere. Typically, a lot of that oil ends up going to Europe, again, for the biodiesel sector. But I suspect China might be picking up some of that oil as well, some sort of backdoor purchasing and the way to get our canola into their marketplace. So because their demand for vegetable oil, again, remains very strong. So that's a positive. You know, it's great to have additional volume moving out, but we've added an extra middleman in the process here. So that has had a negative impact in terms of our price per se, or limits our price, because we just have an extra player an extra transportation and extra costs that have to get pulled into the system as well. Our domestic crush, I suspect, is going to be record large again this year, maybe around 9.8 million tons. I'll tell you this much though, since the beginning of the marketing year till now, the weekly crushing pace that we are at right now, if we're able to maintain that throughout the remainder of the marketing season, we'd probably crush over 10.5 million tons this year. But that's going to be off the charts. But that's not going to happen because our total absolute crush capacity probably is in the order of near 11 million tons. But nobody operates at 100% efficiency. There's Eastern crushers who have scheduled crushers. They'll shift to soybeans or other products. There's maintenance downtimes and such. And the crushers themselves, nobody operates at 100% capacity. So operating 85, 90% capacity, that seems to be about the norm. And if we do that, 9.8 million tons. So the limitations on our crushing capabilities is because we don't have the infrastructure to crush more. Otherwise, that opportunity would certainly reside. So where we are on the markets right now, I've got a long-term canola graphic, goes back to 2008. And similar to what we saw in the soybean one earlier, where are we going to go with these markets in 6 months? I don't know. I don't have 20/20 vision. This is the last meeting I'll be able to actually use that joke. So. But when I look at the opportunity of this marketplace, and I was encouraged up until recently of where we were headed, you know, you could see the red lines bringing out what a technician calls an ascending triangle, where you have a series of rising lows, higher and higher lows, but butting its head against the ceiling over and over again. Now, typically in an ascending triangle, that's like tightening the coil of a spring. And typically the breakout of such a pattern is to the upside. But what happened? July of 2018, Trump's trade war with China was initiated, and all ag markets took a hit given the uncertainty. Uncertainty breeds fear, fear breeds selling. And in that environment, we don't have the speculative players participating on the long side of the marketplace like they typically might do in a normal situation. We have commercial players who are uncertain about our canola trading relationship with our major foreign buyer. So instead of taking a lot of anticipatory buying and helping support the marketplace, they're taking a more hand-to-mouth approach to the market. So the absence of that both speculative and element of more aggressive commercial buying in the market has created a softer price environment. And when I was looking at this, again, we're trading 2 to 3 years of maybe nearby futures, top end 530 a ton, bottom end 475, 480, let's call it. What I think has happened in this trading environment that's become uncertain because of politics involved in our trade is we've moved one standard deviation down in the range. So now the top end of the market was the old lows in that 475, 480 area. The bottom end now is maybe 440, 450. And that's the environment we find ourselves in today. But again, supportive vegetable oil scenario is at play here, and it's continuing to develop. You can see here from a global vegetable oil stocks to use ratio, the ratio of ending stocks for the year relative to how much we use in that year is going to get tight this year. It's probably the lowest it's been since the late 1970s. Palm oil is rising to 2.5-year highs now. Soy oil is rising as well after coming off and bottoming in late 2018 to early 2019, is starting to make a move higher. And our relationship to other competing oil seeds out there, in this case soybeans, canola is considered a high oil content oil seed, and its healthy oil attributes historically suggest that canola is priced at a premium relative to soybeans, in this case as a median around $50 a ton. That can range quite wildly, as it here suggests, year to year. But what this graphic says, at about a $25 to $30 premium relative to soybeans, canola is not all that expensive. So canola still, to my mind, is relatively on sale. So we're not losing sales because canola is expensive relative to other oil seeds. In fact, quite the opposite. We're cheap. In fact, Canadian canola is the cheapest canola rapeseed on the planet right now. Much cheaper than European product. Part of the reason why we're doing business to Europe now. So that's an optimistic thing, I think, underlying supportive feature. But as long as this debate about our relationship with China, and Meng Wanzhou is in detention in Vancouver, that Huawei executive, creating a diplomatic row between the two countries, and as long as this process remains intact and our trading relationship is disjointed with a significant buyer, I suspect canola will probably be an undervalued relative to its other oilseed competing features for the time being. So the best chance for canola to popping to the upside is the vegetable oil story continues to go up. If we see problems materialize with the South American soybean crop that has now just been planted. Otherwise, in my mind, canola's top end from cash value perspective for the time being, once we cross the $10 a bushel area at the farm gate, and get towards $10.50, that could be around the top end of the market. In my mind, with the supply-demand variables we have, that's where it's at. If we wouldn't have this Trump trade war in place and the effects, again, of the Huawei executive Vancouver, I suspect canola would be $1 a bushel higher today based on the same variables. So that's the world we're living in. So my message to my own clients is one where we're looking to maximize use of cash advance as best we can. Looking for local basis opportunities, and when they arise, those specials pop up from time to time. Hopefully we can migrate them into using a deferred delivery position, try to capture as much storage carry as you can in the market, and time them with what I suspect are going to be these 3 to 6 week periods where we have some kind of bounce in the futures market based on whatever the issues of the day are. And hopefully that gets us those kinds of pricing opportunities. Okay, let's take a quick look at wheat. Supply-demand issues last year, the bars here are representing production, the line representing consumption. Last year, production fell short of consumption, so we had a slight curtailment in terms of ending stocks, but this year it looks like despite some problems in various parts of the world, production is exceeding consumption potential. So ending stocks worldwide are still expected to be quite comfortable from the market's point of view. So that picture hasn't changed. The situation when it comes to our own spring wheat markets, in this case I have Minneapolis spring wheat futures. I took, back in the fall time, I took a measurement back from the high to the low from June to September. And just again, from a technician's point of view, using a Fibonacci type retracement, like 50% of that move down, back up, rebounding back up 50 to 62%. That retracement zone put us into what we had as a fall time rally. And I was very light in doing forward selling on wheat this year because of the problems getting the crop in the ground in many locations. We had drought in the south, too much rain in the north. There was certainly a lot of uncertainty about our wheat. Wheat has become the most complicated commodity to market these days, much more so than, say, a canola, which has more standard type marketing associated with it. With all the variances of protein, of grade, of folly number, and other attributes, wheat has become a much more complicated commodity. So the uncertainties of knowing what we had in a diverse type growing environment we had last year, I didn't take advantage of too much selling opportunities, but I was telling my own clients, look, typically there's a seasonality to the wheat market. We tend to bounce sometime in that September-October period, and in this case it happened. Part of that rally came with a bit of the panic that was associated with we were going to have a significant quality downgrade this year. Part of it came with Russian wheat prices during this period were also on the rise, so we had a lot of buyers stepping forward internationally and making some purchases. And also here locally at home, with the lateness of this year's harvest, commercials locally had significant export programs in place, and they wanted to get an aggressive program out there. So they weren't getting the canola to fill the commercial pipeline early because of the lateness of harvest, so it bid up the marketplace. So we got into that 50 to 62% retracement zone, which I have termed the box, crossed that threshold line, and that's certainly where we started our sales program this year. And now we're kind of in the hangover period of this market in terms of maybe going too far up too fast and now correcting down, and we're going into a lull that I think probably carries through the holidays, because this is a really slow time of the grain marketing season. But I suspect that we are in the process now of creating some bottoming action on these markets, because I look internationally, I see Russian wheat values starting to make a move higher and are continuing to edge higher. European wheat values since September, when they bottomed, moved up, pulled back a little, but are still holding up. So international prices are still holding there. So when I look at the things that are affecting the grain markets right now on the negative side, spring wheat demand might be a little less because of the blending needs of some higher other classes like hard red winter wheats that typically some places will blend hard red spring wheat into to get the protein up. Protein isn't a problem as so much around the world this year. The Canadian wheat crop, like I said, StatCan numbers came out last week, 32.5 or so million tons of overall wheat production, but there's ideas that wheat crop is actually bigger than that and will get reflected in future reports. And spring wheat futures in particular, with the worries in the U.S. northern states where there were some quality issues, there's worries of that wheat was delivered into the commercial pipeline in the Minneapolis-Duluth cash market. So there was worried about that wheat being delivered on the short end of the leg of the futures positions. That has provided some of that November selling pressure on the marketplace, but I think that is starting to subside right now. The positives, Russian wheat prices rising. Europeans, while their crop is bigger this year, their prices are still holding up and moving a little bit higher. And I'm sure more and more discussion is going to be about the southern hemisphere wheat crop, which is in the process of being harvested. Australia, Argentina in particular are the ones that are being watched. And I suspect that there is going to be a buying reload after a lull period, after an aggressive move in September, October amongst the major wheat importers. I think the next buying reload happens sometime in this January, February, March period, and we'll probably see some opportunities materialize out of that. And then we'll have fall planted wheat that was throughout the northern hemisphere, whether it's in the United States, the FSU countries, European Union, less than ideal growing conditions for the crop as it goes into dormancy. However, I take that with a grain of salt because winter wheat crops, they're determined after they break dormancy in the springtime. So, but if we have a wheat market that is starting to move higher over the course of the winter, this discussion point will probably enter into it as the media looks for news to explain why wheat prices are moving higher. But I can't take away from this, when I look at the long-term trend of wheat, and this is a weekly graphic going back a couple of years, there is a long-term downtrend that is in place on wheat. And I suspect that in the short term, we're probably in the process of carving out a low. We'll probably have another bounce, take us back up to the trend line. But the big long-term perspective, still, it's hard to be bullish wheat at this point. Until some new variable, new catalysts come along to change that picture, the overall situation is supplies are comfortable on wheat, but the next opportunity is likely coming along and it will probably provide a bounce, and I suspect somewhere on the order in terms of a cash return, maybe 50 cents a bushel above what you're looking at today, say for a 1 CWS 13.5 protein wheat. So we'll be looking for that opportunity over the next 1, 2, or 3 months. Okay, I'm going to just give a quick look at the barley. I know my time is running up quickly here. The stocks, when I look at the barley scenario here domestically, it actually looks relatively comfortable if you look at it from the broader perspective. Last year we had cash barley prices go up to some of their highest levels we've seen in the history in my career. New crop prices were heavily discounted on ideas we're putting a lot more barley in the market in terms of production in this past year, and that has indeed been the case. But yet we've seen a bounce higher again in the feed barley market. And I want to stress that this is a unique scenario that has developed in our feed barley market that is very much localized here in Western Canada. We're not seeing this taking place on the international market. So we see a bounce here, but we see, oh, sorry, I didn't have the graphic up for you, but we see that short bounce higher that we've seen just this fall time in terms of new crop pricing. Higher production, 10.3 million tons of barley, relative to historically, it may be not all that significant, but in the last 10 years, we have seen an increase of barley production relative to the last 10 years as more interest got into it with the pricing that we saw from the old crop environment. But we've seen stock levels, or anticipate stock levels, to start rising from the extraordinary tight scenario we encountered in the last crop marketing year. The key to me about barley is that the supplies are out there. The problem is it's in the wrong position. The surplus, there's a difficulty in the deficit areas, of which southern Alberta is, relative to the surplus areas more to the northern parts of Alberta and throughout Saskatchewan. So we're having difficulty moving product in sufficient volume through the commercial pipeline. There's only so many trucks, and the demand is stronger than that. We've had 2 short crops in southern Alberta because of dry conditions, and we have a feedlot that is operating profitably and is running full right now, and demand is high. So we only can force so much barley through that garden hose pipeline from the surplus areas of the prairies. Over time, I suspect that probably gets addressed, and we do have an opportunity, and maybe we have some relaxation in cash barley pricing. But for the time being, that scenario or that situation remains in place, and the demand pull remains strong and holding the marketplace up reasonably well. And I suspect that this year, those cash prices will probably continue to hold up higher than what the supply-demand balance would normally suggest. Barley exports, I've read in newspapers and such that they're expecting barley exports higher this year. I disagree. I look at cash barley traded, the last I saw a couple of weeks ago, traded price out of Vancouver was $190.95 a ton US. When I minus off rail freights and bring back that into Saskatchewan, and then add truck into southern Alberta, that works at, to about $210 a ton. And relative to about $230-ish or so a ton in the cash market here in southern Alberta, I suspect that the demand element for the barley market remains fixated here in Western Canada. The export market is not providing sufficient income to make significant strides in terms of export. So the premium market is here. And compounding the demand element here is I think there's going to be a whole lot less U.S. corn coming across the border this year. If I look at, say, like a March 380 futures, Chicago corn futures, the rule of thumb basis on that, maybe 90 cents a bushel added to that for all the associated costs to get that product into southern Alberta, convert it to Canadian dollars, add on the unload fees of the train loads and trucking and move it where it needs to be in the feedlot here, that's probably $250, $260 a ton relative to a $230 cash barley market. So again, barley is still the cheapest feed grain available at the moment right now, so the demand, in my mind, probably stays relatively strong. We're certainly going to be attracting more feed wheats and into the process as well, but ultimately there is a good underlying feature to the barley market in place. Question was, are the USDA numbers right? USDA came out with their supply-demand numbers yesterday. No changes relative to the previous month. We're going to find that out in January when it's their key report. That's when final production numbers are determined. I suspect that corn crop is smaller than what is being currently suggested in the United States, but ultimately we may not know that for a long term yet. It's similar to what I think is happening here in Canada with the late harvest and the amount of acreage that is still left in the field to be overwintered. We're going to have some of those issues in the United States. We may not know the size of the U.S. corn crop, nor the Canadian wheat and canola crops, probably until maybe as late as even September of next year when next grain stock numbers come out. So that's going to be the guessing game of the future. But for my mind right now, the barley market remains well supported. However, I am aggressively sold on barley. I'm 70% sold because I think this is a unique opportunity that has manifested itself that wouldn't have existed if we would have the transportation to satisfy needs. You move 1 million tons of extra barley from the surplus areas into the deficit areas, and it's only transportation stopping it. We'd probably be 40, 50 cents a bushel lower today on barley than we are right now. So I want to be aggressive selling that. I know there could be conditions in the winter and that move the marketplace. There could be a rally in the corn market that helps give a sympathy rally to our own feed grain markets. All of that is indeed possibilities, but I think I still want to take advantage of the price opportunity I see available to us today. Okay, with that, I already know I've overrun my time, but I thank you very much for your time today. I still look at this as, in my mind, I was doing these talks last year, I felt the next year ahead was going to be a year of survival for us as we're in challenging grain markets with turbulent political issues and otherwise. But there is going to be pricing opportunities manifesting themselves from time to time, and I think there's going to be profitable ones during the course of this marketing year. But I have to think about things as not the new bull market immediately in front of us, but looking for those 3-6 week periods where we see a bounce in the marketplace. Those are going to be our chances to pick away at this. So with that, I do wish you the very best in the holiday season again, and very much thank you much for your time today.
Thanks, Mike. We'll entertain a question or two. Anybody's got a question or two? Are there mics out in the crowd? I can't see them out there, Daryl. Where am I blind? Right in front of the camera guy is a mic, I guess, and another mic over there. Hard to see out here with the lights. Any questions? How many durum growers out in the crowd? Mike, anything you can tell us specifically on durum, because it tracks quite differently than the wheat complex?
Well, one thing I found interesting about durum, and again, we did have a spike, certainly for the element of high quality durum early in the fall season. We had cash bids getting above $8, in fact tapping in some locations as much as $9 a bushel for top quality durum. The marketplace has settled back since then. A lot of what's going as the market has settled back, but I was interested even from the supply demand numbers that came out yesterday from the United States. Durum supplies are going to be tight, and I suspect Canadian supplies are going to be tightening up this year as well. What I'm waiting for is how the next, and Algeria tends to be a very significant durum purchaser and a customer of ours. They're less buyers of top quality durum, and there are some more like a 3 grade with a 60% HVK value. So they are more of a medium quality durum buyer this year. But I suspect we're going to see buying interest materialized, and again, like I say, on the spring wheat, sometime over the next probably 2 or 3 months, once we get a better evaluation of what the Algerian durum crop, which is just going in the ground right now, I suspect the next opportunity on durum is probably going to be coming up. So I think we have a lull in the market that's taking place now. If I was a seller of durum, my inclination would be to hold off for the time being and see how the picture looks later into the winter, into the early part of spring, and then look to sell again into a deferred delivery position, whether it's in May, June, July, or such, as what may be our next best pricing opportunity. Because I suspect ending stocks on durum, both from Canada and the United States, are in the process of tightening right now. So I think a better pricing opportunity is coming.
Is that mainly on the top quality grades though, or will three CWs or three quads get pulled along with that?
You know, I think buyers, durum to me is a marketplace that is fundamentally changed forever, in the sense that there used to be a buying environment where Canada #1 was the standard and was what everybody wanted. That's no longer the case. When we had a period of time, we had durum prices advanced to $10 a bushel or so. We found buyers like the Tunisias, Moroccos, Algerias, who buy significant tonnages of durum each year, found that to make their couscous or other products that they use the durum product for, they didn't necessarily need the highest quality, and started buying lower priced, cheaper quality types. And I think that scenario remains in place today and will continue going forward. So we have a new spectrum of buyer that has fallen away just from the #1, but with the blending capabilities that we and others have, we're going to see, I think, probably still, even with the tightening of supply as an aggregate, higher prices develop both on the high quality and on the medium quality, though obviously the premiums will get associated with the high quality.
How many pea growers out there? Not too many. Quickly on peas, China has remained a good customer for peas, right?
They have. And I suspect, not just in peas, but I think in pulses in general, we've gone through 2 years of a difficult scenario, especially one that is derived from politics, because India has been the 800-pound gorilla historically of the pulse market. You know, they are the biggest producer, consumer, importer of pulses in the world until recently, when they've instituted tariffs and non-tariff barriers to trade. So for our peas, for instance, it's not only that they've put in high tariffs to restrict trade, they put tonnage restrictions. So for the entire year, March 31st to March 31st, which is their crop marketing year, they only allow 150,000 tons of peas, period, from anybody, Canada, US, Australia combined. Until that scenario changes, it's hard to imagine a marketplace that gets aggressive in terms of wanting to chase a market higher. Luckily, we do have China, who has stepped up and as a significant buyer, and has been a very good buyer this year so far as well, and has been supportive to the marketplace. But some of the issues regarding the winter pulse crop that is now going aground in India, some discussion that there may be government changes of policy maybe afoot, that may be a little premature thinking, I suspect. But as long as we only have one of the two gorillas going, China is going to remain a relatively passive buyer, I think, of peas, still taking volume, but not willing to chase the price higher. They'll look at FSU countries like Ukraine and Russia, who are increasing their pulse production as well, as a potential source. They'll use more soy meal if those peas were destined for the feed market. But I suspect we are turning the corner. We've gone to 2 years of bottoming in the marketplace. So you're already starting to see some premiums in the yellow peas and on the lentils that are starting to come up. And I think into the second half of the market, your pricing opportunities probably get better. But in my mind right now on yellow peas, if I see $7 a bushel, I'm probably a seller.
Was there some questions here? Somebody put up their hand? Yes, sir. Yell it out. We can probably hear you. Yes, it's sort of what you addressed with
right.
with India and whether or not they're going to change their tariffs and change their needs.
You know, I can't remember if I have that graphic up here or not. You know, in terms of significant buyers of Canadian peas, for instance, you know, you can see in the blue bars, that was India of the past, in the past couple of years, past 2 years, and including what this marketing year, is going to be curtailed. Again, there are tonnage limitations as to what they'll take total from all countries combined. China has stepped up in a significant way and are a big buyer. And thankfully so, because this pea market would be in real trouble without them. But we've been dealing in an environment that has traded down to low $6, below $6 in Middle Point, Saskatchewan. But I suspect that with not only here, but worldwide, there has been an element of contraction in overall pulse production. So we're seeing a tightening of inventories. We're seeing the prospects of an India winter pulse crop, which is their main pulse crop of the season, is too wet during planting, severe planting delays going on right now for that pulse crop. If there are issues materializing down the road, that changes the India's government policy and allows a more fluid transaction, that may present an opportunity. But I think from a pricing point of view, I think we've bottomed. After 2 years of struggling in this market, I think we bottomed. I don't want to get bullish about it, but I think that, like I say, we can edge ourselves up to $7 and maybe a little bit better, but I think that's probably the top end of the market until the India policy changes.
Any other quick questions before we move on? Don't want to cut off discussion. Mike might be around for a few minutes, so you can catch him during
Certainly.
the break as well. Ladies and gentlemen, please join with me in thanking Mike Jubinville.
Thank you very much.